So look, good news for interest rate rise that's coming. I think it's inevitable that they will still put it up. If they don't, I'd be very surprised, and I'll probably send the market into an upward spiral, not a downward spiral. So I closely follow the monthly indicator, CPI. Nobody else has really followed this other than the last year, now that CPI or inflation is sort of out of control a little bit. So look, good news is that it did come back down again. Hopefully that means that it's on its way down and not up. So you can see from the first line, it says that it rose 6.9%, but it's comparing to the year before. Keep in mind as well that different things have happened over the last year, so it's only comparing to October last year, so it's a yearly indicator. But this is now a new release that gets released, gets reported on monthly. So it is lower than the previous month. I won't go into the details. You guys can read this at your leisure if you wish. But you'll see, when is it released? I don't think it released today. So last week I spoke about some significant media releases coming out this week. So this is one of them. So you can see how we were tracking, 2020, it was really crap, nothing was happening. You can see before that, this is where it really should sit between 2 to 3%. So we were tracking a bit lower, interest rates were declining, and then, we were tracking a bit higher, and, we were due for a property correction anyway, without COVID. COVID just, pushed that back, and then it was accelerated well and truly beyond what it should have been. So, look, we're sitting up here. It's probably news that you guys already know because it's all over the media, but hopefully it looks like it's tracking back down. Last time I looked at it, this was 6.9, and then it spiked again. But that's also dependent on, it's a yearly moving average. So you got to look at, what was happening in, that was September 22. Keep in mind there's a month behind. So you look at, what was September 21. So September 21 was 3.1. So, one would expect that as we start to move into, December, then January, we were really increasing back a year ago. So I would think that this is going to come back down, but we can't all have crystal balls, but hopefully that's on a downward trajectory, which is a good sign. And I think it will be. I think we have definitely well and truly peaked, because off the back of, CPI coming back down, and construction is a major contributor to that at the moment, as is fuel and fruit and veg for whatever reason, maybe shortage of labor. But building approvals continue to fall. So there's been multiple consecutive months of total building approvals. So all that means is that there's less building, less pressure on supply demand. The other week I heard from a couple of builders that the price of steel actually came back down, which is good news. Once we start to see immigration come in, at least the cost of construction should come back down, or it at least should level out with no increases, which is being normal normally, that you don't, between 3 and 6 months, you don't see construction price increases. If anything, as the market cools, those prices actually contract because there's less work available. So then builders are more competitive, and so are the subcontractors. So this is good news. If you're looking at building in 2023, I'd say it'd probably be returning to a normal market in terms of building. So I wouldn't be too worried about it from here on in. Probably the biggest thing with construction is that, now that the market is cooling and there's a lot of negative media sentiment around it, is financiers, especially some commercial financiers, that have contracted. So finance is going to be a bit harder in the next 12 months. So, just be prepared for that. You're going to pay more for finance. But what is going to carry you through is nobody else is going to be, or very few people are going to be building next year. So you're going to get sharper building prices. And then once you come out of next year, I think towards the end of the year, interest rates are going to start to come back down, and then you'll be selling into an inflated market. So building at one price, building in one market, and then selling into an inflated market. So that's how you make more than, 20, 30, 40%. And a lot of people did it during COVID. You built at the old prices, you built through COVID, and then you were selling into, a highly inflated market. You're not going to see the market turn as quickly as what it did in COVID. But yeah, if you get, an extra 10% growth from the property, you get basically the cream, and you've built it at old prices when builders are more competitive. So just be prepared for that. I have said heaps of times that I think the next 12 months is going to be the best buying opportunities. It might get cut short than 12 months, or it might run a bit longer, but I think all signs are pointing to that it's probably not going to last 12 months. So just make sure you're looking, or at least, start to tie up some sites over the next little bit. The other consideration, or the other release that just came out, is retail turnover falls for the first time. So we are looking at October. We just had Black Friday, so it's probably going to spike for the month of November, and then leading up into December, it normally increases, but we'll see how it goes. So it only fell 0.2%. It's not huge, but at least it fell. So it talks about, this is the first monthly fall of the year in retail trade, following a 6.6% rise. So, it's a marginal fall, but it just means that we hopefully have peaked and we're not going to go through, another high peak over November and December, hopefully. Any questions on that? No, all good. There's a couple of articles I see. I actually quite like Macro Business. I don't always agree with their perspectives, but I think they have a wide range of data they report on. So I actually don't mind, the data that they reproduce. So there's a couple of articles which I want to touch on around this sort of stuff. So RBA warns on rental price inflation. I don't really think that that's a major consideration with inflation, although it says that it contributes 6% or something like that to, our CPI increase. And I think the rental market overall will increase, but you've still got pretty big markets in Sydney and Melbourne, a lot of units that are sitting vacant in certain areas. So I can't really see that meaning that our inflation is going to be spiraling out of control because rental prices are going up. So I just take this with a grain of salt, but I just thought this was interesting that he's, Philip Lowe has come out and said that, Australian rents will soar in 2023. But I think all that's going to mean is, with rents increasing and interest rates probably coming back down in the later half of 2023, we're going to start to see properties that are maybe neutrally geared then go into positively geared territories, or properties that are negatively geared go into positively geared territory. So I think there's going to be, the buying opportunities now and in the next 6-12 months for if you're, looking at developing and then holding the stock and holding it, positively geared or neutrally. I think that there's going to be some arbitration with interest rates and rental returns like there was before. So, when interest rates start to contract, then obviously rental yields stay the same for a period of time. And then as property increases in value, then, those rental yields start to drop. So I think there's going to be some good buy and hold opportunities, or, develop and hold, which is what I prefer to do, because you can only make so much money from doing so many developments. When you start to hold properties, then you can get the power of, time, and you're not actually physically trading. Even with a development, it might be highly leveraged with your time, but you can never outperform somebody who's holding, 100 properties and they're growing overnight in value. And, the rent's being pushed up as well. I saw this article around, the biggest drops in suburbs, and you guys can look up this data as well, where are the biggest drops. I thought it was interesting around, if you are chasing a bargain or bargain suburbs, whether or not development works in these suburbs is another question. But, if these areas are posting, negative 24% annual change, it's pretty substantial. And what I've seen in the markets that I'm in, and, I'm not familiar with these markets, is that this, change in median value, all it meant was people stopped paying, 20% over the market, and now they start paying the market value. So if the property was 1 million, people were paying sort of 1.2, they were just overbidding or overpaying. And now that market's come back to the 1 million where it should have been to start with. So whether or not that's happened in these suburbs, but I thought, it's painting a pretty bleak picture of these markets coming back by 25%. So me, with my thinking hat on, thinking, there's probably some real bargains to be had in some of these suburbs, whether for development or not. But, obviously you want to try and buy a property under market value and add value in some way. And, through this program, it's development. It can be through other methods, but I just think development is the easiest out of all of them. But, just buying under market value, sitting, holding a property, I think people are going to be making a whole lot of money in the next couple of years, in the next cycle. So anyway, I thought that was interesting around the biggest drops. They're pretty substantial, but to be honest, the suburbs I'm in, if anything, they've probably still continued, even though I've been reading media articles about Sunshine Coast and Brisbane having declining markets, overall. I've not personally seen that in any of my projects. I've probably seen a stabilization of prices, if not, slowly etching up. But the only thing that's really dropped off is the buyer activity, but it's still better than what it was pre-COVID. There's probably double the buyer activity now in the estates I'm selling versus 2019. So anyway, it's an interesting market, but I don't think we're really going to see too much of a bloodbath in really tightly held areas where people haven't gone, really spastic over paying huge amounts for properties like they haven't done, the 20% over the market like they've done in a lot of coastal areas. Then you read, another article talking about housing prices close to the bottom, which this one I actually agree with. I think we are pretty close to the bottom as a nation, potentially even at the bottom. Just think about how many people that, are even in your close network, people that aren't necessarily that educated, that are sitting on the sidelines waiting for the market to bottom. Or people perceive that it's at the bottom and interest rates stop to, increase. So I think depending on what the RBA does, if they're smart, they'll just keep etching up rates really slowly. Otherwise, if they just pull the plug and stop putting rates up, then the Australian general consumer is going to think, okay, this is the rate now, so let's all jump in and buy property because now we know what the rate is going to be. And I think that it has the potential that it could just swing back the other way really quickly because everybody will jump on the bandwagon. And there's so much undersupply at the moment that it's not going to take much buyer demand for it to actually turn the market quite quickly. So anyway, I thought they were interesting. Just a bit of an insight into a couple of articles and those media releases. So I think my crystal ball for the RBA next month might be a maybe 0.15. Hopefully 0.15 increase. They might go 0.25 and then they might do 0 in December. But I think if I were them, I'd probably do like a 0.15 or 0.1 and then another 0.1 in December. And then maybe, who knows what will happen in early next year. Any questions? All good? Anyone else got any other views? Hopefully you agree with me. If not, you're entitled to your own opinion, but let's see who's right. It's not about being right. It's just about being in the market. And if, we can't all get it right, but I think it's just good to have a look at, overall stats, try and make a valid prediction as much as possible and, go for it. If you're going to jump in, I've been looking at stats on properties for a number of years, and they're just really weird at the moment. Like they're just not how they've ever been before. And I've heard so many of my mentors talk about it just being a super weird market with where we are at the moment. And same with during COVID, like they've never seen, and these are guys, some of these guys are like in their 70s, like they've never seen a market the same as this. So anyway, I just think it's an opportunity of a lifetime to get in. If you missed or you think you missed the boom, that was post-COVID. I think there's another one coming. Just may not be as fast, that's all.